They just crossed the Rubicon. The United States Justice Department didn't just serve legal papers to the Federal Reserve. They didn't just ask for documents. They just initiated a hostile takeover of the American monetary system. For the last 72 hours, the financial media has been trying to spin this story. They are calling it a procedural inquiry. They are calling it a transparency measure. Do not listen to them. When the executive branch threatens the central bank with grand jury subpoenas and criminal charges, it sends one undeniable message to the global bond market. The Federal Reserve is no longer independent. The era of the inflation fighter is over. The era of fiscal dominance has begun. This single move has lit a fuse under global confidence that cannot be extinguished. And you can see the panic first where you always see it first, in the metals. Gold and silver are ripping higher as 2026 opens. They aren't waiting for the press conference. They aren't waiting for the court date. They are pricing in the reality that the Fed chair is now negotiating with a gun to his head. If you are thinking, John, is this just another political headline? Stop. You need to understand the gravity of what just happened. The entire global financial system rests on one fragile assumption, that the Federal Reserve is free to make unpopular decisions to protect the dollar, that they can raise rates even if it hurts the politicians, that they can stop the money printer even if it crashes the stock market. That assumption just died. The DOJ subpoena is the government telling the Fed, do what we say or we will destroy you. And the market knows exactly what the government wants. The government wants lower rates. The government wants cheap debt. The government wants infinite liquidity to fund its deficits. When the people who control the interest rates are under legal siege, risk-free assets stop feeling risk-free. Treasury bonds wobble, the dollar narrative cracks, and the assets that have no counterparty risk, gold and silver, start acting like they smell smoke in a crowded theater. This is why, 2 weeks into 2026, metals are acting like the brakes have been cut. Gold doesn't move like this because a random analyst got excited. Silver doesn't stretch like this because social media got loud. This kind of move, multiple standard deviations above the norm, happens when trust starts leaking out of institutions. We are witnessing a repricing event. The market is realizing that the dollar is now a political tool, fully captured by the state. And when a currency becomes a political tool, history tells us exactly what happens next. Debasement. They will print to pay the legal bills. They will print to pay the interest. They will print to keep the illusion alive. You are not watching a bubble. You are watching a fire alarm. The smart money is moving from paper promises to hard assets, not because they want to get rich, but because they want to survive the capture. Bridge phrase. But to understand why this specific legal threat guarantees a future of runaway inflation, we have to look back at the last time a president pointed a weapon at the Federal Reserve, the ghost of 1970 that is haunting the markets today. Let's start with the history that the mainstream media is terrified to mention. They treat this DOJ subpoena like it is a new, unprecedented legal drama. It isn't. We have seen this movie before, and we know exactly how it ends. The last time a sitting U.S. president and his administration exerted this much direct, hostile pressure on a Federal Reserve chairman was in the early 1970s. The president was Richard Nixon. The Fed chair was Arthur Burns. The recordings from the Oval Office tell the story. Nixon didn't use subpoenas. He used bullying. He leaned on Burns. He told him, Arthur, my boy, you need to keep the money flowing. You need to keep the voters happy. Nixon needed cheap debt and a booming economy to win the election. He didn't care about the long-term value of the dollar. Arthur Burns caved. He surrendered the Fed's independence. He kept rates artificially low when he should have raised them. The result? The Great Inflation. A decade of double-digit price rises, gas lines, and the near-total destruction of the bond market. Gold went from $35 to $850. Silver went from $1.50 to $50. They tell you that the Fed is an independent institution. The reality is, the Fed is a political piñata. The DOJ subpoena is the modern version of Nixon's phone call. It is the capture of the central bank. When the market sees the Justice Department threatening the Fed chair with criminal liability, the market instantly understands the new rules of the game. Fiscal dominance. Fiscal dominance is a technical term, but the concept is simple. It means the government's debt fiscal policy is so massive that the central bank monetary policy has no choice but to print money to fund it. The Fed cannot raise rates to fight inflation because doing so would bankrupt the U.S. government. The Fed must print. They must buy the bonds. They must debase the currency. The DOJ is simply the enforcer, ensuring the Fed complies. The bond market smells this weakness. That is why yields are jittery, and the metals market smells the blood. That is why silver is launching. Investors are realizing that there is no Paul Volcker coming to save the dollar. There is only Arthur Burns 2.0, handcuffed by the Department of Justice. Now, let's move from the political theater in Washington to the physical reality in Shanghai. While the Western paper markets are reacting to the legal news, the Eastern physical markets are reacting to actual scarcity. We need to talk about the Shanghai premium. In a healthy, functioning global market, the price of silver should be roughly the same in New York, London, and Shanghai. If silver is $90 in New York and $100 in Shanghai, traders will buy in NY and sell in Shanghai until the prices match. That is called arbitrage. It keeps the world in balance, but the balance is broken. For months, we have seen premiums in Shanghai running 8% to 10% higher than the spot price in the West. That is not a rounding error. That is a screaming signal of distress. It means that despite the paper price in New York saying one thing, the physical hunger in China is saying something else entirely. Why isn't the gap closing? Because the metal is moving through a one-way valve. Physical bars are being drained from the Comex and LBMA, London, vaults. They're being loaded onto planes and ships. They are flying east to capture that premium, but they never come back. Once a 1,000-ounce bar enters the Chinese industrial complex or the Indian jewelry market, it is consumed or hoarded. It does not re-enter the Western financial system. The West is bleeding its strategic inventory to feed the East's insatiable demand. They tell you the price is set in New York. The reality is, New York is just the showroom. Shanghai is the warehouse, and the warehouse is emptying the showroom. This creates a vacuum effect. As the Shanghai premium stays high, it acts like a giant suction hose attached to the Western vaults. It sucks the registered inventory out of the Comex. We have seen registered silver levels, the metal actually available for delivery, plummet. At some point, the inventory gets so low that the Western banks cannot honor their paper contracts. That is the moment the paper price snaps up to meet the physical price. We are watching the slow-motion drainage of the Western financial system's collateral. There is a third factor driving this squeeze that almost nobody discusses because it is buried in boring banking regulations. It is called Basel III. For decades, the big bullion banks, the short sellers, played a game called unallocated gold. They would sell you gold or silver on paper. You didn't own a specific bar. You owned a claim on the bank's general pool of metal. It was fractional reserve banking applied to metals. They could sell the same ounce 100 times. This allowed them to suppress the price with infinite paper supply. But the rules changed. The net stable funding ratio, NSFR, under Basel III changed the classification of unallocated gold. Suddenly, holding paper gold on a bank's balance sheet became expensive. It became a liability that required more capital reserves. Physical gold, however, was upgraded to a Tier 1 asset, as good as cash. They tell you banks manipulate the price down. The reality is, the new rules force them to stop the game. The banks are now incentivized to get out of the paper short business and get into the physical long business. They are clearing their books. This is why you see the open interest, the number of paper contracts, behaving strangely. The banks are unwinding the massive short positions that suppressed the price for 20 years. Why? Because under the new rules, being short gold, silver is toxic. Being long physical gold, silver is salvation. This removes the ceiling that has capped the price for a generation. The paper smash is dying because the regulators accidentally killed it. Without the banks constantly smashing the price with naked shorts, the natural forces of supply and demand are finally taking over. And natural supply, mining, is falling, while natural demand, solar, AI, India, is exploding. The regulatory dam is broken and the water is rushing in. Now, let's talk about the elephant in the room, the player that hasn't even entered the game yet. We have talked about the DOJs, the Shanghai premium, and the banks. But the real force, the one that turns a bull market into a mania, is the institutional money. I want you to visualize the global financial ocean. Retail investors, you and me, are speedboats. We are fast, we turn quickly, but we are small. The banks are destroyers, big, powerful, dangerous. But the pension funds, the sovereign wealth funds, they are the aircraft carriers. They carry $50 trillion in capital. Right now, the average global pension fund allocation to gold and silver is roughly 0.5%. It is a rounding error. They own almost zero hard assets. They are loaded to the gills with government bonds, 40%, and tech stocks, 50%. But remember the DOJ subpoena? Remember the loss of Fed independence? That signals the death of the bond market. If the Fed is captured, inflation is guaranteed. Bonds, which are just long-term promises to pay dollars, become certificates of confiscation. They tell you institutions don't buy rocks. The reality is they have a fiduciary duty to survive. So, what happens when these pension funds realize that bonds are dead money? They have to rotate. They don't need to go all in. They just need to move from 0.5% allocation to 1.0% allocation. They just need to return to the historical mean. Here's the math that breaks the market. If global pension funds try to move just 0.5% of their $50 trillion into precious metals, that is $250 billion of new buying pressure. The entire annual production of silver is worth roughly $25 billion. The money coming in is 10x bigger than the metal available to buy. This is the institutional wall. When the California Teachers' Pension or the Norwegian Sovereign Wealth Fund decides to buy silver, they don't buy a few coins. They buy entire mines. They buy 10,000 contracts at once. We are staring at a supply squeeze where the unobtainium phase begins not because retail woke up, but because the giants got scared. Finally, we have the last domino, the one that hasn't fallen yet, but is wobbling. The retail public. Right now, despite silver hitting $90 and gold hitting record highs, the average person on the street has no idea what is happening. They're still arguing about politics. They're still watching sports. This is what we call the stealth phase, but the attention phase is coming. What happens when silver crosses the triple-digit line? What happens at $100? It becomes a headline. It goes from page 16 of the Wall Street Journal to the front page of USA Today. Your Uber driver starts asking you about silver. Your brother-in-law calls you asking where to buy coins. This is the mania. And unlike the institutions, retail investors are emotional. They don't buy on dips. They buy on spikes. They chase. When the public realizes that their currency is losing value, that the DOJ has captured the Fed and inflation is the policy, they will panic buy hard assets to protect their purchasing power. We saw this in 1980. People lined up around the block to buy silver at $50, which is like $150 today. We are approaching that psychological tipping point. The supply is already gone, Shanghai Vacuum. The paper shorts are exiting, Basel III. The giants are rotating, pension funds. When the retail mob arrives at the empty vault, price discovery will be vertical. We have arrived at the conclusion. We have connected the dots from the DOJ subpoenas in Washington to the emptying vaults in Shanghai. We have exposed the capture of the Federal Reserve, the end of the era where interest rates were set by economists, and the beginning of the era where they are set by politicians. We have analyzed the Shanghai Vacuum, the one-way valve that is bleeding the West dry of physical metal. We have stared up at the institutional wall, the mathematical certainty that when 50 trillion of pension money tries to squeeze through a door built for 25 billion of silver, the price function breaks. The verdict is clear. We are not looking at a trade. We are looking at a regime change. The 40-year bond bull market is over. The era of risk-free return is dead. We are entering the era of return-free risk, unless you own the collateral. When the government captures the central bank, they have only one tool left: inflation. They will print to pay the legal bills. They will print to fund the deficit. They will print to keep the voters happy. And in that environment, silver is not an investment. It is a life raft. So, what do you do before the pension funds flood the market? Here is your battle plan. Step 1. Become your own central bank. If the Federal Reserve is compromised, you cannot rely on the currency they issue. You need assets that have no liability attached to them. That means physical possession. If your exposure is in an ETF that leases metal from a bank that is currently being sued by the DOJ, you do not own silver. You own a lawsuit. Get the metal in your hand, or get it in a vault outside the banking system. Step 2, do not sell the first spike. When silver hits $100, the temptation to sell will be enormous. You will see green numbers on your screen and feel like a genius. Resist. Remember the pension funds. They haven't even started buying yet. If you sell at $100, you are selling to BlackRock. You're selling to the California Teachers Fund. You're giving away your position right before the main event. Hold for the ratio. Hold until the gold to silver ratio compresses back to historical norms, 31 or 15:1. Step 3, watch the bond yields, ignore the stock market. Watch the 10-year Treasury yield. If yields spike while the Fed is printing, it means the market has lost control. That is the signal that the doom loop has begun. That is the moment when price becomes irrelevant and availability becomes everything. I want to leave you with this. There's a famous definition of power. Sovereign is he who decides the exception. For 100 years, the Federal Reserve was the sovereign. They decided the price of money. They decided who got bailed out. But this week, with the DOJ subpoenas, the Fed lost its sovereignty. It bowed to the state. If the central bank is no longer sovereign, then you must be. You must decide the exception. You must hold the keys. In a world of captured institutions, the only independence left is the weight of the metal in your safe. Don't wait for permission to protect yourself. They aren't coming to save you. The mainstream financial news will tell you this is a transitory legal matter. They will tell you to stay in the 60-40 portfolio. They are designed to keep you asleep. We are here to wake you up. If you want to navigate this transition with clarity, if you want to stand with the few who understand that the rules of money just change forever, then you know what to do. Join us, subscribe, and turn on notifications. Because the next time I speak to you, the pension funds might be in the market, and the price of admission will be a lot higher. Secure your sovereignty. Watch the vaults, and I'll see you on the other side.